right, what is up, you guys? In this video, I'm going to be going over what is Forex, who trades Forex, and how to trade Forex. And on the how to trade Forex side of things, I'm just going to go right into the smart money concept so that you experienced traders, that of which have been trading more than likely retail style trade, can see the concepts and the main differences and distinctions amongst each other. So just gonna get right into it. What is Forex, FX for short, the foreign exchange markets? So you're based out of a country right now, wherever you're watching this video from, if you attracted this video into your life. Greetings, salutations from Dallas, Texas in the States. But your country has a specific currency, and that currency has a value dictated based on that country's economical situation, fundamental news releases, bombs, interest rates, even presidential tweets can spike volatility into the market. So it's good to be aware. And you see these physical exchanges when you go into the airport, right? And that's because in order to participate in another country's economy, you need their currency. That's why you physically buy and sell, exchange one currency for the other based on an exchange rate that is formulated through two currency pairs. Now, as digital day traders, we're not doing anything physical. There is no ownership. We're essentially buying and selling on margin through contracts. We buy a contract at a specified price, and if that contract appreciates in value and goes up, we make money on the buy side and vice versa on the downside. But as digital day traders, we're doing market execution type orders, instantaneous buy limits or sell stops through our MetaTrader 4s directly from our phones and from our laptops, right? We're in that digital day and age. It's efficiency and just effective market execution instantaneously, no lag time. So that's pretty much what is Forex. Essentially, you can make money both ways. You buy and the market goes up. You sell and the market goes down. You're making money. Now, on the who trades Forex side of things, this is the, you have to keep an open mind, but it's true until proven otherwise. So you can see that there's a fine distinction between two overall parties in the foreign exchange markets, and it's a ratio that exists in life. First off, let's look at the 3.5 to 4.5 success rate that exists. This is a true statistic, right? The success rate is at a 3.5 to 4.5 success rate. Therefore, 96% of Forex traders never become profitable. They never succeed. And why? What are the 96% doing? How can we use that to our advantage? How is the collective, in terms of the foreign exchange markets, how are they perceiving and going about trading? That's super key. And well, in this next slide, you can see from 2016 to 2019, the top 10 currency traders in the foreign exchange markets. It's not surprising to see that it's the largest world bank. So overall, a collective view controls a significant portion of a market share or volume in the foreign exchange markets, right? So a collective view control the overall economy in the foreign exchange markets they own. And what is that a clear reflection of? As above, so below. You can see that in life, right? The top 1% has a net worth equating to that of the bottom 90%. That's a huge wealth gap and disparity in income. But once you see, you can't unsee. Let's look at other world systems. Pharmaceutical, right? We're never going to get cures for cancer and diabetes because there's too much profit on the line and it's set up for control. The 6 media conglomerates that just utilize the 5 C's in marketing and create a division, factions, opposition, that of which is controlled by the same people. And then the money system, right? He or she who controls the money system will control the world. Well, the money markets is just a subcomponent or a subsystem of the money system, right? Money market investments, money markets. There's a handful of money markets, and they're just subcomponents of the overall money system. And as above, so below you guys. It's just set up for profit intended purposes and control, right? They have enough volume and market share in order to manipulate and control the markets for profit intended purposes. And ask yourself this, guys, if you had enough market volume and share in order to manipulate the price action in order for your profit, would you or would you not do it? Right? You probably would. And this continues to happen. I'll attach an article for the most recent indictment, and again, they don't even lose all the gains they made, right? They pay pennies on the dollars for getting in trouble. They gladly pay the millions, right? Because that's insignificant compared to the overall profit that was gathered. And so smart money versus dumb money, right? The big institutions versus the average retail trader, which ultimately makes up 95% of the economy in the foreign exchange markets, right? But once you understand these two parties, these two factions, the division between both, and you start understanding how they both perceive the market, you can now start to align with these big institutions. But first, you have to be able to see how both parties perceive and approach and trade this money market. So this is an accumulation schematic. This is Wyckoff logic for those of you that don't know. And just a little bit of history. The first exchange was back in the 1650s out in Amsterdam. So the first novel of a trader was documented back in the early 1700s, and it was in Spanish. So I like that. And there's a chapter where they call there's a chapter called herding, and herding is to accumulation, as accumulation is to consolidation, as consolidation is to side trend, right? This is the beginning. It's accumulation of what? Herding of what? Every type of order that exists on your MetaTrader 4. Buy stop, sell stop, buy limit, sell limit, right? And it's knowing, first of all, how it is that retail traders trade. 95% of retail traders uses those mainstream patterns, Forex patterns, or stock patterns that you can find all over Google, right? Head and shoulders, support, resistance, breakout pattern. And that's a big clue, right? Because if 95% of traders never make it, but 95% of traders utilize and perceive the market in the same way, well, what's the deal, right? There's something here. So I think the biggest key is in knowing how it is that these smart money, large financial institutions actually trade. So first nugget is these big institutions have to hedge. So what does that mean? They buy and sell at the same time, right? They buy and sell at the same time. Why? Because we're talking about billions of lots, right? Just so you can understand, they buy billions of lots. It would just keep going up, and vice versa on the way down. So what they do is they average down. They have to hedge in order to get into the markets, and they need our stop losses. They need our liquidity, right? Liquidity of the 96%. And so it's as if they target the support and the resistance, right? They access the buy limit, the sell limiters, the buy limiters, and then they, go up and activate the buy stoppers. They go down and activate the sell stoppers just to bring price action back away from them. It's just accessing every stop loss. And when you start to understand what liquidity is, you can synonymously refer to liquidity as support and resistance, because that's where 95% of stop losses are placed. And stop losses aren't just for risk management. Stop losses can be defined as the price level at which you sell your order back to the market. Back to who? These big players. They need our orders to get into the markets. And then understanding that they hedge. So they buy and sell at the same time. But for example, they buy 40 billion lots and they sell 20 billion lots. And they're in drawdown in one position just to capture liquidity. And then they come back and mitigate out of their position. They break even because big players always win, just to do it all over again. And that's just the repetition we take advantage of, because every trading style aims at the aspect of probability. You're just heightening your accuracy rate. I think 5 trades out of 10, a 50% accuracy rate is fair enough, because we know that risk management, profitability trumps probability. You will never win 10 out of 10. So risk management is where the pros play, right? Risk management, managing their risks. But these financial institutions play off of our psychology, play off of the way we actually trade. So they know that 96% of retail traders, of newbies, are in that insanity phase, the probability phase, right? Trying to identify the best trading style, the golden indicator, the best signal services. And all these people get clipped, right? Because all their stop losses are placed in the same place. And that's really how these big financial institutions take advantage of it. And honestly, it's just theory until some insider comes out and says, yeah, we take advantage of the knowledgeability of knowing how 96% of traders trade, and we take advantage of it. We take advantage of their support and resistance levels, capture them, and do it all over again just for our profit. Until some insider comes out and says that. It's a theory, but again, probabilities, right? We take advantage of patterns, repetitive sequences. The difference between smart money and retail trading approach is really that the patterns that we take advantage of allows for precision-based entries. So the importance in that is the importance of any vehicle of investment, right? What's most important for every vehicle of investment is every vehicle of investment is set up for profit intended purposes, right? So if you can show an investor, I have a way to reduce your initial cost of investment or your average range of risk per order. Say again. I'm interested. Show me the numbers, right? And we'll do just that. So I'm just gonna go show you the actual concepts. The next video is gonna be probability and profitabilities. So you really, really wanna subscribe and make sure you get that notification for the next video, because the next video is that foundation, that mathematical foundation with which you can build upon. Any area of interest or profession that you commit to, right? There's going to be a lot of teachers and mentors for that area of mastery or profession, right? So as an effective student, you know what it is that you're there to learn, right? Who's right? What is opinion? There's overlapping agreements when it comes to areas of masteries amongst teachers and mentors. So as an effective student, you want to find the overlapping agreements amongst all these teachers in that specific area of mastery or profession, right? And usually it's the components and mechanisms of. And when it comes to day trading, it really has to be mathematics, understanding the difference between probability and profitabilities and the mathematical concepts that fall under in terms of day trading. And that's going to be covered in the next video. So you really want to watch that next video if you really want to go pro. So check it out, guys. We identify the footprints of these institutions, right? So this can be called an energy candle, an interest candle, a point of interest candle, an institutional candle. Learn the synonyms, guys. How do you identify a footprint, right? Like I said, they hedge. So first off, what did I say? Support and resistance get rated. They get captured. That's the liquidity these large players need. So that validates this candle. Okay. And now what happens? Down candle before the up move, right? What do they go up to? Well, where's the money? Where's the liquidity? Where's the support resistance? Learn the synonyms, guys. That's where price action goes into. But again, just as an example, let's say they shorted 20 billion lots, but they bought 40 billion lots, right? To move price action up. And those 20 billion lots were in drawdown. So once they hit liquidity, captured some more orders, they have to bring back price action and mitigate out of their position, right? And the big players always win. They mitigate out at break even or even in profit. So we identify that candle, the open, the 50%, and that allows you for precision based entry. So, like I said, the patterns we take advantage of allow for precision based entries, that of which reduce your overall average stop loss, your pip range parameter risk. And when you can enter with 10 pip stop losses or 7 pip stop losses and input 1%, and that results in being that huge ADR for the day, that's how you do that 1 to 10, that 1 to 20. Because I'm sure most of you have heard the logical mathematical explanation most self-proclaimed mentors give you, right? They put up their 5 fingers. Guys, you don't have to win them all. You can lose more than you win. So they say, you see, look, lose 3 at a 1 to 3 risk to reward, you lost 3%, right? But those 2 wins, you did 3%. So it's 6 minus 3, net profit 3% for that week. And then, someone logically sees this, that means everyone can do this. And that's true, but let's break past the barriers. Just because things have been done in the same way doesn't mean that's the right way. Vehicle of investments are for profit intended purposes. So let's break past that 96% ceiling of a 1 to 2 to 1 to 4 risk reward range per order. Guys, you want to break past that and start experiencing the 1 to 10, 1 to 20 risk reward per orders. Why? Because in that way, all of which will reflect on your trading log is small losses, right? Small gains, that of which are one at a range of 1 to 2 to 1 to 4 of your losses, your small losses. And number 3, big gains, right? That 1 to 10, that 1 to 20, that 1 to 30. Maybe you swung and you held for a few weeks, that 1 to 50, 1 to 100. That's what you want to add into your trading log, because that's what makes you a more profitable trader. Vehicles of investments are for profit, not for intellectual / entertainment purposes, trying to be Nostradamus, just drawing up charts, predicting them. Yes, everybody can predict, but it's in the timing, and he or she who reduces the average risk becomes much more profitable. You want to go from probability to profitability. A lot of people who get lost, they're just stuck in probabilities. They want to win 10 out of 10. They want to make back that big loss. They look for that golden indicator. They look for the best trading style, not understanding that trading styles are just meant to make you profitable. But a trading style that focuses on profitability, that's what a calculated and knowledgeable investor is interested in. So again, you can see previous levels of liquidity, so or support resistance, where is the money? And then you see this up candle that rated, this double top that a lot of sell limiters were selling. Maybe some people, there's information on the left that breakout traders wanted to, get into the market if it breaks out. So it technically captures two order types, right? And that validates this as an IC candle. And then they take the market down, where past previous levels of liquidity. And then what happens, you see that down candle before the up move, you see how you get that wick back into that candle, right? Back into that open candle, a very precise entry. And then they go back to the theoretical open orders that they have maintaining, right? Because they leave open orders and they always break even, they always mitigate out. And knowing how they trade and how this repetitive pattern exists and keeps on repeating every week, as day traders, we see this every week. This is our play. You can start seeing the difference between retail and smart money concept traders. And same thing, guys, repetitive thing. This is Euro odd on the 60-minute. So you see liquidity capture, breakout traders and double top sell limiters got captured, and then you see the market go down, right? The up candle before that down move, it formulates liquidity for future reference. And then what happens, right? They come mitigate out of that order. And the beautiful thing that happens after that is you get the fractal repetition of it all. So if you see the top chart, I don't think my mouse is gonna be moving on the YouTube video. But if you see the top chart, look at that pattern. You know, that big, you know, accumulation that ends up, you know, going down and distributing. Um, it's the same thing that gives you that stack entry, just in fractal form. It's the same exact thing. It's the same pattern. It comes back and mitigates out. And on the stack entry, yes, you know, we go into an imbalance and another candle for reference, but it's the same exact thing. It's just in smaller version. The market is fractal. Therefore, the patterns you see on the higher time frame, these smart money concepts, look at them on the monthly, on the weekly. We look at the highest time frames and then dissect like a surgeon into the lower time frames. But if you see that, you can kind of see that the market is fractal and repeats in higher frequency on the lower time frames, but not in an infinite amount. It's a finite. This is more mathematical than anything, guys. So same thing. This is the daily, and you know, this is for, you know, higher time frame traders, so you can see, right? So you see that up candle before the down move that we have boxed in a purple box. But look at the previous candle, that bearish candle, right? And you see the arrow on top of that bearish candle. That means that there's 24 1-hour candles in that bearish candle, right? That make up that bearish candle. So the up candle, you know, that big wick, what that means, what the story that tells is that those highs, or those equal highs, were captured, right? And then it closed in such a way, right? That's so sus. Like, it closed in such a way. Like, some people might call that a doji or whatever. I don't read candles that way. I don't sell or buy based on dojis, guys. You read candles in terms of what's happening. What that means is that the price action was up there on lower time frames and then came down. It was up there because it was capturing equal highs. So then the candlestick closed in that way, right? Up candle before that big down move. Then you see liquidity being formed at the bottom. Why? For future reference. And then what happens, guys? Price action comes back and mitigates out of that position. And this is on the daily. And this is my baby. This is GBPAUD. I trade this pair. I know this pair. And it just comes back and mitigates out of that position with such precision. And that's on the daily, guys. So as you can see, we do trade different. Our concepts are different. But again, we did experience about 2 years, I myself 2 years, my mentors 3 to 4 years of trading retail style methods. And on the next video, not the next video, but the video after that one, you're gonna see how I was a precision-based pattern retail trader and how I had to make the shift into being a precision-based smart money trader. But that's pretty much it for this video, you guys. Like I said, the next video, I'm really going to get into the mathematics, right? Into what's most important. I think math is the language that of which is the most factual, right? If you have a mathematical understanding, the basis with which you build upon is a much more effective one, right? You can see this slide. It's not done, but you see that the mathematics, the pillars at the bottom are the mathematic concepts, right? Probability and profitability. They're the distinctions between them and how you can build upon them. Because a lot of methods or styles of teachings usually just throw you into psychology, technical and fundamental analysis, and then risk management. But a lot of people need that refresher course in terms of probability and profitability. Those are two mathematical terms that have distinctive mathematics within them. And obviously, since these two mathematical terms are embedded in this profession, there's an overlap, and that's in the precision. And again, the next video is going to go deep into that, and I'm sure you're going to enjoy it. I've talked to 10-year veterans, 25-year veterans, 35-year veterans in any and every market this is applicable. And you know, that's pretty much it for this video. So make sure to leave a comment with any question, press that like button, and make sure to subscribe so you can get notified on the next video releasing. Thank you guys so much for watching, and I will see you all on the next one.